It began with a pattern no one wanted to see. Small transfers here, seemingly innocent invoices there. A string of deposits and withdrawals that individually looked legitimate but, when stitched together, formed a map of deception. At first, bank compliance officers called them anomalies. Then regulators called them risks. By the time investigators called them evidence, the trail had already snaked through dozens of banks across continents, carrying with it hundreds of millions, maybe billions, in dirty money. Money laundering is an old crime given new life by modern finance. The basic idea is simple. Take cash earned illegally, from drug sales, bribery, fraud, cybercrime, and make it look clean. But what this story reveals is how that simple idea has been weaponized into a global machine that uses trusted institutions, elegant paperwork, and the illusion of legitimacy to hide crime in plain sight. It started with one bank's compliance team running a routine screening. They noticed a cluster of accounts all behaving oddly. Large inbound transfers would arrive from companies registered in obscure jurisdictions. Within days, funds would be routed through a chain of correspondent banks, swapped into different currencies, and then paid out as consulting fees or logistics expenses. The paperwork accompanying these transactions looked professional. Invoices, contracts, even notarized signatures. On paper, everything checked out. What the paper didn't show was the pattern. The same names reappeared in different guises. The same shell companies surfaced again and again. Some entities existed only on a filing with no employees and no physical office. Others showed a one-page website in a language none of the investigators spoke. But every so often, a tiny inconsistency appeared. A timestamp that didn't match the declared business hours, a digital footprint that connected an offshore consultant to a location far from where its address supposedly was. Those inconsistencies were the first threads. Pulling on them slowly revealed a fabric of deceit. Money laundering traditionally follows three stages: placement, layering, and integration. Placement moves cash into the financial system. Layering obscures the origin by shuffling funds through complex transactions. Integration returns the money as apparently legitimate profits or investments. What made this network so dangerous was how it used banks, the very institutions designed to stop illicit finance, as instruments of layering and integration. The network's architects were experts in paperwork and in people. They registered shell companies in tax havens. Cyprus, the British Virgin Islands, the Cayman Islands. They opened corporate accounts in mid-sized banks with less aggressive compliance programs. They exploited correspondent banking relationships to move money across borders with minimal scrutiny. For years, their transactions slipped beneath radar thresholds. When systems flagged something, their human touch smoothed it over. A banker who accepted a persuasive explanation, an auditor who didn't dig deep, a relationship manager who prized deposits over due diligence. Cryptocurrency added a new layer of options. Criminal proceeds could be tokenized and moved through mixers and tumblers, then cashed out via exchanges with lax KYC controls. Luxury assets, real estate, yachts, art, became integration vehicles in cities where accountability was thin. A penthouse in a global capital, bought by a company with no staff and no business, suddenly looked like a legitimate asset on a balance sheet. The trail grew bolder. One investigator, poring over suspicious activity reports, noticed recurring transaction descriptions: shipping, consulting, software license. The vendors associated with these descriptions had no working sites and no real employees. They were corporate chimera, companies that existed to move money. The transactions were choreographed to create plausible business narratives for regulators and auditors. But money laundering isn't only about fake companies. It's about people who facilitate the process, sometimes knowingly, sometimes unwittingly. Lawyers, accountants, bank officers, and corporate service providers. Those who provide the paperwork, the Know Your Customer, KYC documents, the nominee directors, became part of the network. In some cases, they were paid handsomely. In others, they were deceived themselves. The line between accessory and accomplice often blurred. The real breakthrough in this case came from an odd place. Email metadata. A forensic analyst discovered that several of the shell company domains pinged back to a single server cluster in a city that had no registered offices for the companies it hosted. Cross-referencing WHOIS data and firewall logs revealed a misconfigured server that leaked identifying information. It was a tiny mistake in a vast machine, but it was enough to begin unraveling the network. When investigators followed that lead, they found a network of service providers who, knowingly or not, had been selling legitimacy. One provider offered complete company formation packages in under 48 hours. Registered address, nominee director, bank account setup. For a fee, you could acquire instant corporate identity and a veneer of respectability. For criminals, this service was gold. Layer by layering, the investigators connected shell companies to mule accounts and payment processors. They mapped the flow from local cash-intensive businesses, companies whose real revenues were small, into offshore invoices and then into foreign accounts. Shadowy consultancies billed six-figure advisory fees to ghost firms, and those funds reappeared as rental income, investment returns, or corporate dividends. In some cases, the money circled back into the global financial system through legitimate channels. Corporate acquisitions, real estate investment trusts, or large purchases that required clean capital. At the heart of the scheme were three core vulnerabilities: weak due diligence, regulatory fragmentation, and profit-driven bank culture. Banks often compete fiercely for corporate clients. Relationship managers are incentivized to onboard deposits quickly. When profitability pressures combine with complex international structures, due diligence can become an afterthought. Compliance departments are frequently under-resourced, and when they do flag activity, investigations can be slow and bureaucratic. Meanwhile, different jurisdictions have different thresholds and incentives for anti-money laundering enforcement. Criminals exploit that patchwork. The case widened. Journalists obtained leaked spreadsheets, and the names of beneficiaries began to surface. Politicians with unexplained offshore holdings, corporate executives with assets beyond the value of declared incomes, and intermediaries whose public profiles didn't match the scale of their transactions. The Panama Papers and similar leaks had shown how systemic the problem could be. This new case showed how it could adapt and persist. One of the most startling revelations was how deeply the network penetrated local banking infrastructures. In one country, investigators found that a dozen regional banks had accounted for 70% of the suspicious transactions in a 6-month period. These banks had less sophisticated transaction monitoring systems and thinner compliance teams. They had become the preferred access points for thousands of laundered transfers. Deposits came in small enough amounts to evade immediate detection. Aggregation and onward transmission happened in ways that obscured origin. Enforcement agencies mobilized cross-border task forces. Regulators in multiple countries opened inquiries. But the network had planned for disruption. When investigators froze certain accounts, the money was already gone or moved through alternative channels. Some criminals shifted strategies, using consortia of small financial service firms in jurisdictions with lax reporting rules. Others leaned on technology, the use of encrypted messaging apps to coordinate payments, or cloud software to spin up new corporate identities in minutes. Public outcry grew. Newspapers published exposés that connected anonymous shell companies to high-profile properties and to political donors. Lawmakers called for stricter transparency, for beneficial ownership registries, and for more robust international cooperation. Banks announced reforms, updated KYC procedures, more aggressive transaction monitoring, and higher investments in compliance technology. But implementing change is slow, and the criminal networks are fast. The human cost of the laundering network was not just abstract. In one coastal town, a local pension fund's investment income had been quietly siphoned into an offshore account, leaving retirees with smaller payouts. A municipal infrastructure project was financed with laundered funds, creating a moral crisis about whether public projects should accept money of unknown origin. Small business owners who had unwittingly served as front companies faced legal investigations, reputational ruin, and the slow process of proving they were victims. Technology played a paradoxical role. It both enabled sophisticated laundering and enabled its detection. Blockchain forensics tools, machine learning models for anomaly detection, and international data sharing initiatives gave investigators new power. Analysts could visualize flow graphs across thousands of transactions, identify common nodes, and trace funds through multiple currency swaps. In one key moment, blockchain analysis exposed a pattern: multiple streams of crypto payouts that always converged on a single custodian service before being exchanged for fiat. That custodian turned out to be a thinly regulated exchange in a jurisdiction slow to respond to subpoenas. The public learned that money laundering is not just about hiding cash under mattresses or inside luxury cars. It's about integrating illicit proceeds into legitimate economies in ways that are functionally indistinguishable from lawful business until someone peels back the layers. That reality makes prevention politically and technically difficult. After all, who wants to slow down credit flows or add friction to legitimate commerce? The tension between financial freedom and financial integrity is real. One breakthrough came when a whistleblower within a corporate service provider decided to speak. They handed investigators an internal ledger showing payouts to a list of nominee directors who, on paper, provided legal cover for dozens of entities. That ledger linked nominees to phone numbers and emails used to manage bank accounts. The whistleblower's documents revealed a repeatable pattern. One provider created hundreds of entities, then used a small network of bank relationships to place funds and layer them through correspondent banking channels. Those documents accelerated prosecutions and asset freezes. Prosecutions followed, though the path to conviction was long and complicated. Prosecutors had to prove knowledge and intent, that intermediaries knew the companies were vehicles for laundering. That is a high bar. In many cases, companies were fined, nominees removed, and bank officers disciplined. In others, the trail stopped at a jurisdiction unwilling or unable to present evidence. Still, some successful cases resulted in significant penalties and, in rare instances, extraditions. As arrests were made and headlines screamed about high-profile corruption, the network adapted. New providers emerged, new banks were recruited, and the laundering routes shifted. The cat-and-mouse game continued, but each disruption made the networks more cautious and, paradoxically, more ingenious. They automated checks to avoid triggering pattern recognition systems, diversified the jurisdictions they used, and blended criminal proceeds with large legitimate cash flows to make detection harder. The long-term changes were not just legal or technical. They were cultural. Banks increased budgets for compliance. Some implemented real-time analytics that flagged suspicious layering patterns previously invisible. International cooperation improved as regulatory bodies recognized the need for speed. Nations that had been safe havens for shell companies faced pressure to implement public beneficial ownership registries. Transparency advocates won some victories. Lobbyists and vested interests pushed back. For ordinary people, the takeaway was sobering. Money laundering undermines markets, corrupts institutions, and changes the structure of opportunity. When illicit wealth buys influence, contracts, or media, the democratic process is threatened. When laundered funds prop up criminal enterprises, society pays with violence, addiction, and instability. The visible crimes, a drug shipment intercepted, a fraudster arrested, are only the tip of an iceberg whose base rests on money that has been washed, mixed, and reintegrated. The story closed one chapter when authorities dismantled a key ring of intermediaries. Banks tightened controls, regulators shared data faster, and whistleblowers came forward more readily. Years later, however, the presence of laundered money remained. New forms emerged: virtual assets, online marketplaces, even the exploitation of legitimate crowdfunding for illicit ends. The network's core tactic was constant: disguise, diversify, and integrate. This is a tale of how the financial system, essential for commerce and development, can be weaponized to hide and amplify criminality. It is a story of human ingenuity used for harm and of persistent investigators determined to unravel complex deceptions. It is also a call to action, to demand better transparency, to fund compliance with purpose, And to remember that every anonymous company and every unchecked transfer can have consequences far beyond a ledger entry. In the end, the trail of money laundering is hidden not because the criminals are invulnerable, but because the systems meant to stop them were never designed with perfect foresight. They were designed for commerce, not for the ingenuity of those who would exploit them. Exposing that trail required patience, curiosity, and the willingness to follow tiny inconsistencies until a picture emerged. It required whistleblowers willing to risk reputation and livelihood. It required international cooperation that transcended politics. If there is hope, it is in transparency. If there is a tool, it is in rigorous data analysis. And if there is a moral imperative, it is in demanding that the institutions we trust serve the public interest rather than the interests of those who hide behind paper and shell. The hidden trail snaked through banks, yes. But every trail leaves marks. Every mark can be followed. The work continues, and the more people who know how to read the map, the harder it becomes for the money to be hidden again.